What we're looking at is how much the U.S. stock market swings up and down. Over the past 5 years, it's been volatile. Remember those days of the S&P, the Dow Jones going up or down 200 or 300 points at a time? Well, take a look at this, because this is a chart of the S&P 500 and the daily average price swings going back to the Great Depression. So you can see here, back in the 1930s, a huge move, especially around 2.5% on average per day back in the 1930s, just after the Great Depression. Now, there's been a lot of volatility, a lot of noise going in the decades since then, but I want to focus your attention on this part. This is the Great Recession, what we saw over the past 4 or 5 years. Now, on average, over the past 5 years, the stock market, the S&P 500, swung by more than 1% a day over the past 5 years. Now, that stock market volatility is less than 0.5% per day. Now, the reason why this is important is because so far in 2013, on average, the S&P 500 has only gone up or down by 1% on just 4 separate days so far in 2013. On average, over the last 5 years, you could count on 7 days a month with the S&P 500 going up or down by more than a full percent. Now, the bulls say that this decrease in stock market volatility is a positive sign. One, Deirdre, that may draw equity investors back into the market. That's a good sign. But of course, the bears say that this is all market complacency and that investors need to be aware, at least, of what's going to happen on the possible downside for U.S. stocks, Deirdre.